Okay, hello everyone. I'm James Hart and welcome to this Orbex Trader Education session where we're going to be talking about the Stochastics Indicator. Now, for those of you who aren't familiar with the Stochastics Indicator, along with other indicators such as the RSI, which we looked at last time around, it's one of the most popular Forex technical indicators, and for very good reason. So over the course of today's session then, I'm going to talk about what the Stochastics Indicator is exactly. I'm going to talk about how it can be useful to you in terms of helping you understand price movements and find trade opportunities. We'll also discuss some specific trading methods, some basic and some advanced, as well as allow time for some Q&A on the indicator. So as ever, if you have any questions during the course of the session, please just write them in the chat box. And what I'll do is I'll stop periodically as we go along. And then, as I said, I'll also leave some time at the end. But as ever, let's jump straight in then, okay? And so what is the Stochastics Indicator? So the Stochastics Indicator is a momentum indicator, which also has a structural reference built in, meaning that the indicator is looking at the most recent price closed compared to the high and low of price over a certain predefined period. So what this indicator essentially is doing is measuring momentum in the market, e.g. measuring the strength of price moves and categorizing them as either overbought or oversold. So in terms of what the indicator looks like, the indicator looks like this, okay? So you can see this oscillating line, hence why it's often known as the Stochastics Oscillator. Now, the indicator is set up in the same way as the RSI, meaning that it's a bound oscillator. So once again, we have this upper and lower limit that we need to consider. But you'll note that with the stochastics, it's slightly different this time. So the upper limit is set to 80 and the lower limit is set to 20. So the upper limit is the line at which momentum is classed as overbought, and the lower threshold is the line at which momentum is classed as oversold. Now, one thing that's important to highlight straight away is that the default settings are typically 533 on your MT4 platform, but as ever, you can actually customize these settings. Now, it's worth spending some time actually playing around with the settings and looking at some different levels. But what you need to remember is that for the most part, where the settings aren't vastly different, there won't be too much change. However, you do need to consider that the higher your settings are, the less sensitive the reading will be to price, because you're looking over a much longer range. And the lower your settings are, the more sensitive the indicator will be to price, because you'll be focusing on a shorter term range. As I say, 533 are the standard settings for the indicator. Another thing to point out quickly is that although the indicator is similar to the RSI indicator in that we're measuring momentum on this oscillating basis between these two thresholds, you'll notice that we actually have two lines this time. So we have the D line and the K line. So the K line is the slower of the two and the D line is the faster. And essentially, whenever the D line crosses above the K line, it's classed as bullish. It's a bullish development for price, and vice versa. When the D line crosses below the K line, it's classed as bearish. But we'll look at that a bit later in better context, and I'll explain what that means. So this is what the indicator looks like then. This is how it's measuring momentum. So when the indicator moves up above this upper threshold, the 80 limit, that signals that momentum is overbought and vulnerable to a reversal lower. And when the indicator trades down and hits the lower threshold, that indicates that momentum is oversold and vulnerable to a reversal higher. Now, as with most momentum indicators then, when it comes down to how best to trade them, the methods we can use fall into two broad categories. So the first is using the indicator to fade extreme moves, and the second is using the indicator to trade divergence. So let's look at some examples of this then and discuss these methods in more detail. Okay, so in the example then, you can see that I've highlighted several areas on the chart that show where price made a reversal. Now, the really important thing to note here is what is going on with the stochastics indicator at these different points where price made a reversal, okay? So first of all, you can see that down here, we got this sell-off in price, these three extended bearish candles. We traded down into this low before we stalled and put in a reversal higher. Now, it's important to note that at the point that we put in that reversal higher, look what the stochastics indicator was doing. So the indicator moved lower in tandem with price, dipped below that oversold threshold, indicating that momentum is overextended to the downside and vulnerable to a reversal higher. And then as the indicator line crossed back above the threshold, you can see that price recovered and traded all the way up to this point here. So we made a recovery from that first low, traded all the way up to this high here, and then you can see that as price stalled out here and started to dip lower, the indicator too is signaling that a reversal is in the offing, because the indicator has crossed above the overbought threshold at this point. So remember, that 80 threshold signals that bullish momentum is overextended and vulnerable to a reversal lower. And shortly after the indicator crossed above that threshold, you can see the indicator crossed back down and price itself traded lower, trading all the way down to this low point here. So we then traded down to this low point before once again you can see that price stalled out and reversed and traded higher. Now you'll notice once again, looking at the stochastics indicator, the point at which price reversed from is also the point at which the indicator recovered from being oversold. So you can see as price traded down into this low, the indicator too traded below the oversold threshold, stayed there slightly before quickly reversing and trading higher. So as the indicator moved up, price moved up also. You can see we got a really strong rally, broke above that initial high, traded all the way up to this point here, before once again we saw a reversal lower. And once again, you can see that the indicator was mapping the moves we were seeing in price. So as price traded up to this high point, the indicator traded above the overbought threshold, signaling that bullish momentum was overextended and that momentum was vulnerable to a reversal lower. And you can see that we did indeed get that reaction lower. So this time, we didn't see a dip down below the oversold threshold before price recovered and traded to put in a new high. But then once again, at this high point here, you can see the indicator just briefly pierced above the overbought threshold, signaling that momentum was overextended to the top side and that price was vulnerable to a reaction lower. And you can see that once again, we did get a sell-off in price. So this is just a very basic example then of the way in which the indicator works alongside price, but hopefully it's giving you a really good example of just how useful the indicator can be in helping you understand the moves in price, but most crucially in helping you identify and even trade key reversals. Now, in terms of how we trade these reversals then, the most important thing is that we don't just put on a trade as soon as the indicator line hits a threshold level, okay? So where the indicator line hits the overbought threshold, we don't want to go short straight away, okay? We want to wait for the indicator line to cross back below the overbought threshold, signaling that the reversal is underway. Similarly, where the indicator crosses below the oversold threshold, we don't look to buy the market just as the indicator hits oversold. We want to wait for the indicator to cross back above that oversold threshold, showing us that the reversal is underway and allowing us opportunity to enter the market. So it's just a slight filter that we apply to our trade, but it's a really important way of mitigating against taking unnecessary losses and exposing yourself to unnecessary risk. So as ever, whenever we're looking at these different trading methods or trading strategies, what we're always looking to do is improve our chances of success and manage and mitigate our risk as much as possible. Okay, now the reason that we are waiting for the indicator to cross above and below the threshold line, as I say, is because we're waiting for that extra bit of clarity, that extra bit of confirmation that can help us manage our risk and protect against unnecessary losing trades. So let's take a look at an example then. And we can see this in action. So you can see in this example then, we had price trading higher. So we had this nice, strong, bullish rally here, price moving to the top side, only a couple of very small bearish candles in this extended bullish run. Now you'll notice that the indicator crossed above the overbought threshold at this point here. So I put in this red horizontal line to show where perhaps slightly more naive traders might look to get short. So they assume that as soon as the indicator hits the overbought threshold, this means that price is likely to reverse lower. Okay, so we have a lot of people getting short at this point here. However, you can see what actually happens is price continues to trade higher, taking out short stops along the way as it does. And in fact, we don't actually start to reverse lower until this point here. Now, interestingly, you can see that if we'd been looking to only trade the indicator once it crossed back down below the overbought threshold, that we wouldn't have got short until this point here, this large bearish candle, which actually was the first real reversal candle in that bullish run. Okay, so this really highlights the importance of waiting for that extra bit of confirmation with your trade and taking the time to wait for the indicator to confirm the reversal and tip its hat as to where price is headed next. Okay, so instead of getting short as the indicator hits overbought, which it did at this point here, we hold on, we wait until the indicator crosses below the overbought threshold at this point here, when we get this large bearish candle, and that's the point at which we get short and actually catch the reversal. Okay, so let's take a look then at a bullish example of this, and you can see exactly the same thing on a slightly smaller scale this time, but still highlighting the importance of waiting for the crossover. So this time then, we've got price selling off, moving to the downside here. We've got this extended run of bearish candles. Now at this point here, you can see the indicator crosses to touch the oversold threshold, indicating that bearish momentum is overextended and that we're vulnerable to a reversal higher. However, the market doesn't just turn on a dime and head straight back up. You can see that we do indeed start to trade lower again. We put in two consecutively lower candles, posting two new lows in this bearish run, before at this point here we get a reversal higher and the indicator crosses back above that oversold threshold, giving us the go-ahead to enter our bullish trade. So again, it's just a very small, easy modification to make in terms of how you take these trades, but it's very important for managing your risk and mitigating against taking unnecessary losses. Okay, so lots of new traders will simply look to take a trade as soon as the indicator hits either the oversold or overbought threshold. But as you can see, given the tendency of price to often push on a little bit and for the indicator to sort of sit above or below those thresholds for a little bit of time, it really is worthwhile waiting for the indicator to cross back through either the oversold or overbought threshold before actually taking your trade. Okay, now it's important to stress, although we are taking means here to protect ourselves, this isn't to say that trading in this manner rather will help you avoid all losing trades, because as I always stress, there are no 100% win rate systems. But trading in this manner is definitely a smarter and more strategic way to approach the market and to use this indicator, and will certainly help you protect against losses and find better entry points to the market, which is what we always want to be doing no matter which strategy or indicator we're using. Okay, now another really great way to use the stochastics indicator then is to use it on a multi-time frame basis to help you identify directional bias in the markets and then find precise entry points. Now, when I say a multi-time frame basis, for those of you who aren't familiar with multi-time frame trading, all this simply refers to is the process of analyzing the market, so the same instrument, on different time frames to get an overall view and a more specific view of how price is behaving and the direction that price is taking. So let's take a look at an example of this then, and I'll walk you through the process. Okay, so in this chart above, okay, so we've got a euro dollar chart, a daily chart here. You can see that I've highlighted, I've highlighted two horizontal lines, and essentially what these lines do is frame the area where the indicator is moving from overbought to oversold and then stays below oversold until it starts to come up out of oversold. So essentially, if we're trading on the lower time frame, so the intraday time frames, and we're looking to use the daily time frame to get a bigger idea of price direction, so what we do is we simply pull up our euro-dollar chart, look at it on the daily time frame, apply our stochastics indicator, and say, what is the stochastics indicator telling us about price action? So over this period here, the indicator was moving from overbought to oversold. So we know that momentum was shifting from bullish to bearish in the market on the daily time frame. So this means that the dominant momentum in the market was to the downside, showing us that bearish pressure, selling pressure is increasing in the market. So this tells us that the better opportunities lie to the short side, e.g., while the indicator is moving down like that, the better opportunities are to sell price rather than buying it. So now, because we have a higher time frame view of the euro dollar, thanks to looking at the stochastic indicator, what we can then look to do is drop down onto the lower time frames, such as the H1 time frame, and wait for periods where price action corrects higher against the bearish trend, and look specifically for periods where the stochastics indicator crosses into overbought territory, because what that is signaling to us is that on the shorter time frame, the corrective momentum is exhausted. So e.g., where price is moving higher against the overall bearish trend, we're waiting for periods where those small bullish corrections run out of steam, and then that's where we're looking to enter the market as price reverses and the bearish trend resumes. So if we look at this same time, the same horizon here on the lower time frames, on the H1 time frame, and you can see that we've got those large red horizontal lines showing us where the indicator moved from overbought to oversold on the daily. Well, this time you can see that I've highlighted in orange these periods where we would have had the opportunity to set short trades in line with the overall bearish trend that we'd seen on the daily time frame. Okay, so we pull up our H1 chart because that's the chart that we're actually looking to trade off. So that's our execution time frame. But our overall time frame for perspective and direction is the daily chart. So the daily chart is telling us that momentum is shifting towards the downside. And so then we look to the H1 chart and the H1 stochastics to help us find areas to trade. And you can see that we have a couple of really great opportunities here. So price is in this really extended sell-off. All of these corrections so far have been really minor, and the indicator has failed to cross above that overbought threshold. But then you can see highlighted in this first orange box, we get a correction higher where the indicator crosses into the overbought territory and then flips lower. And you can see that during this little corrective run here, we actually get 3 attempts at this. So we get 3 opportunities here to join the market to the downside, anticipating a resumption of that bearish trend. And you can see that from that last run higher and that last peak on the stochastics indicator, we do indeed get a reversal lower. We trade down to new lows here before once again correcting higher. And remember, because we've been looking at the daily time frame, we know that these bullish runs on the H1 time frame are to be considered corrective rather than impulsive. E.g., these moves are counter to the overall trend rather than setting the overall trend. So as price starts to rally higher, we're watching the stochastics indicator, waiting for the indicator to signal that momentum is overbought and overextended and vulnerable to a reversal lower. And then once that is the case, we are able to go ahead and short the market once again. And you can see that once again, the corrective move reverses, it fails, and the overall bearish trend resumes, taking price all the way lower. So as you can see, it's a very simple, straightforward process that you can use on all charts, all instruments, and any instrument, all charts, all time frames rather, and any instrument that you trade. So whether you're trading commodities or equity indexes, or you're trading the currencies, and regardless of whether you trade the weekly and monthly time frames or the daily, H1, and even lower to the M15 and M5, it's still the same process. So you're pulling up a higher time frame chart to get overall perspective on the market. You're looking at the stochastics indicator, saying to yourself, what is the stochastics indicator telling me about the momentum that's in the market at the moment and the likely direction of price? And then you're dropping down to the shorter time frame to find the actual opportunities to trade. Okay, so this is a really fantastic method for trading, and it should appeal to those of you who like to be a bit more conservative and a bit more strategic with your trading, because what we're actually doing is building in two separate sets of criteria. So we need to get an overall sense of direction on the market, higher time frame perspective, and then the trades that we're looking to take on the lower time frame need to line up with this. And the beauty of doing this is that what it actually helps us to do is stay out of a lot of losing trades. So where we've got price moving lower on the H1 time frame like this, you can see there are many instances that the indicator moves to oversold. However, because price is moving in an overall bearish trend, these wouldn't be classed as opportunities to buy. And although some more aggressive traders might take short-term scalping trades looking to get little moves higher, little corrections higher, we know that the better opportunities lie to the short side. And so we're able to stick to our guns, keep our powder dry, not take any trades until we get these lovely opportunities which lie in line with the overall trend. Okay, so we've talked so far about how we can use the stochastics indicator to fade extreme moves in price, e.g. to look to sell when the indicator moves into overbought territory because we expect a reversal lower, and looking to buy when the indicator moves into oversold territory because we're expecting a reversal higher. What we can actually do with the indicator also, which moves us into slightly more advanced trading territory, is looking to trade divergence. So for those of you who've been in some other indicator sessions that I've done, you should be familiar with divergence, but if you aren't, don't worry. Divergence simply refers to a situation where the indicator doesn't support the moves that price is making. So it acts as a bit of a telltale giveaway that a reversal is in the offing. So essentially, if price is rising but the indicator is moving lower, this tells us that the move higher is running out of steam and is vulnerable to a reversal lower. And similarly, if price is moving lower but the indicator starts to move higher, this tells us that the move lower is running out of steam and price is vulnerable to a reversal higher. And the beauty of these is that they can give us really unique trading points to the market and help us capture really fantastic moves. So let's take a look at an example of this then, and I'll talk you through it in more detail. Okay, so here you go. So on the chart here, we've got a textbook example of bearish divergence. So you can see that price is moving higher in this clear bullish trend. We've got price putting higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and so on and so forth, okay? So what we're seeing here is that classic staircase type structure that we love to see with bullish trends. So price is moving higher in a nice zigzag fashion, putting in fresh highs on each run. Now, if you look down to the indicator, you can see that to begin with, the indicator is tracking these moves in price and it's confirming bullish momentum in the market. So we put our first high in here, the indicator puts in a high. We put in our second high here, the indicator puts in a higher high. We put in our third high here and the indicator again puts in a higher high. But from this point here, the indicator starts to flag bearish divergence. So from this price high and this stochastic high, you can see that although price continues to move higher, putting in fresh highs each time, the indicator has actually started to weaken and reverse, and we're putting in lower highs, although we're still seeing these price highs. So once we see this happening, we know that bullish momentum is actually waning and that the potential rather for a reversal is growing. Okay, and as I said, the beauty of this is that it offers you a really unique view on the market, because if you don't understand how to use these indicators, okay, you would simply be looking at this price action alone and thinking, right, price is in a clear bullish trend. Okay, we've even got a gap higher here. the opportunities lie to the top side, and you'd be looking to buy as price corrects lower here. However, because we're looking at the indicator, because we understand what the indicator is telling us about price, we can say, right, from this third high from the end here, the indicator has started to put in lower highs. So although price is continuing to grind higher, this move is likely to run out of steam soon and reverse lower. And instead of trying to get one more diminished high, what we should actually be looking for is the opportunity to trade to the short side and capture a reversal which is going to take most traders offside. So one simple way in which we can look to trade a bearish reversal from a setup like this is to trade a breakdown below the last key support in the move. So if we go ahead and put in our horizontal line here, a horizontal line coming in at that last swing low. So this is the last key support in the move. Price trades up, puts in that final high. The indicator is confirming bearish divergence in the market. Price reverses from that high, trades down, and then what we need to see to confirm this bearish reversal is a break below this last swing low support, okay? Because to negate the bullish trend structure, we need to see that last low broken. Because you can see the whole way up so far, each swing low has been left unbroken, okay? But at this point here, price breaks down below that last swing low. So we've got a real sea change in terms of price action. And you can just see it on the charts, the extended run of consecutive bearish candles. We've got our bearish divergence in play. So we know that this is the area at which we can go ahead and take our short trade. And as you can see, from that point there, taking out that last swing low, where we actually saw a little bit of stalling, okay, we then cascaded lower, and this gave us a really nice profit. So once again, this is a really simple trading setup that we can look to apply to the markets, waiting to identify clear divergence in the market, and then trading a break beyond the last key swing point. And again, if this was a bullish setup and we were seeing bullish divergence in the market, we'd be looking to trade price as it broke out above the last swing high on a bearish run. So that's how we look to trade divergence in the market. And again, it's a really strategic way of approaching the market and really does offer you unique entry points and a great advantage over other traders who aren't savvy with technical indicators. Now, as ever, when we're looking to trade, one of the key elements that we can focus on with a view to improving our chances of success is confluence. So confluence simply refers to the presence of two or more technical elements giving the same signal in the same area. And for those of you who have been in any of my other sessions, you'll know that this is something I talk about a lot. And the reason is that it really does help to increase your chances of success. So with this in mind, a great way to use the stochastics indicator is to identify confluence between the reading the stochastics is giving and another element such as price action or chart patterns. So let's take a look at a couple of examples then, and I'll walk you through this in more detail. Okay, so looking at this chart then, you can see I've highlighted these three peaks here, and hopefully for those of you who were in the chart pattern session, you've guessed it already. So what we're actually looking at here is a textbook head and shoulders pattern, okay? As you can see, we've got a left shoulder here, a head here, and a right shoulder here. And this is a classic bearish reversal pattern, indicating a change of sentiment and a shift of momentum in the market and the potential for a large bearish reversal. Now again, for those of you who were in the chart pattern session, you might remember that one of the ways I like to trade these patterns is actually to be a bit more aggressive, and instead of waiting for a break of the neckline, which is around this point here, which is the key support level in the market, what I actually like to do is take an early trade from the right shoulder. So what I actually look to do is anticipate a reverse head and shoulders pattern forming, and I'll be monitoring price action as it trades into the right shoulder, looking to take a reversal trade there down to the neckline. Okay, and the reason for this is that I found over the years from trading is that whenever these head and shoulders patterns present themselves, especially in a big scale like this, a break of the neckline can actually be quite a hard trade to take, and it can actually take quite a while to materialize. But if you can get in early and trade from the right shoulder down to the neckline, you can quite often catch quite a good run. Now, the way in which I take these trades then is by identifying technical confluence at the site of the right shoulder to give me conviction to take the trade. So what I'm not doing is just taking a trade in level with the left shoulder. So I don't just draw a line on my chart and say, right, this is the left shoulder, that's going to form the right shoulder, or get short from this level. What I do is I mark the line on my chart to give me the left shoulder resistance. And then what I do is I look to monitor price action as it trades up into the area of that left shoulder and see if we have got a potential right shoulder forming. So looking at this right shoulder area then, you'll notice two things, okay, as we get up there. So the first thing is we've traded up to the level of that left shoulder, which we have as resistance, and you can see the price has actually traded higher, pierced it slightly, reversed, and closed with this large bearish pin bar. So the pin bar is a textbook bearish reversal candle that highlights an acute shift in sentiment in the market, and it highlights the potential for a reversal lower. So at this point then, I have a bearish pin bar at the side of my potential right shoulder of this large head and shoulders pattern, okay? So I'm excited at this point because I've got my price action confirmation, or rather, I've got enough of a price action signal to go ahead and take a trade. But then what I'm looking to do is identify one more level of confluence with the stochastics indicator. So I'm waiting for the stochastics indicator to confirm the trade. And as you can see, as price traded up and formed that right shoulder, the indicator did indeed cross above the overbought threshold, telling us that momentum is overextended to the top side and vulnerable to a reversal lower. And you can also see that we had a bit of divergence in there as well, because the first move that the indicator made up, the first price high that was made, the indicator registered a high here, but then each subsequent high after that point was actually lower. So the indicator was putting in lower highs. We got our big bearish pin bar at the site of our right shoulder. So this gives me the technical confluence that I need to go ahead and take a bearish trade. Again, it's just a very simple process, okay? I'm identifying a potential trade zone in the market, and then I'm looking to identify confluence, okay? So in this instance, the potential trade zone was the right shoulder of this large head and shoulders pattern. And then the confluence was the confluence between this bearish pin bar candle, which is a classic reversal candle, and the overbought reading plus bearish divergence shown on the stochastics indicator. So this is a really great example of how you can use this very simple process to identify trade locations and confirm them to take your trade. So one final way in which we can look to identify confluence with the stochastics indicator, and another technical element, is between stochastic divergence rather and other technical elements. So let's take a look at an example of this then and talk through how it works. Okay, so in this chart then, you can see that we have price moving in a strong bearish trend. So we've had a really extended period of declines here. So the market is moving in a heavy bearish trend. We trade down to this point here, and you can see the price actually starts to reverse, and we start to correct higher, putting in this very staggered, labored corrective move. Now, as price starts to correct higher, what we're always looking to do is frame price action and understand our moves. And one of the best ways to do this is through the use of chart patterns. And for those of you who were in the chart pattern session or who are familiar with chart patterns, you can see straight away that what we actually had here forming during the correction to this bearish trend was a rising wedge pattern, okay? So these two converging trend lines then show this rising wedge pattern, which highlight a lack of momentum and waning momentum and waning volatility in the market. So although price is correcting higher here, you can see that the range is actually getting shorter, the moves are getting less severe. And this tells us that momentum is weakening and that price is vulnerable to a reversal lower. So we've got our chart pattern in the market. And then if we go ahead and look to the stochastics indicator, you can see that this thesis, this trade idea, is actually confirmed by the moves shown on the stochastics indicator, because the indicator is putting in lower highs, highlighting bearish divergence. Okay, so price is moving higher, but it's moving higher within a rising wedge pattern, which is forming as a correction during a large bearish trend. So we know that we're waiting for an opportunity to short. The indicator is putting in lower highs on each new price high, telling us that there's bearish divergence in the market and that price is vulnerable to a reversal lower. And so then at the point that price breaks down below that rising trend line low, we can go ahead and get short and capture the resumption of the overall bearish trend. And you can see from that point there, when price broke the low of that rising wedge, we actually cascaded lower. So this was a really great trade to take. Okay, so are there any questions I can answer for anyone at this point? Okay, great. Well, look, fantastic job, everyone. And as usual, I hope you found that session really informative and engaging. I know that for some of the newer traders, some of these concepts can seem a little tough to understand at first, but please just make sure that if there is anything you're struggling with, that you take the time to go back over the videos when you get these recordings and get to grips with what we're talking about in each section. Because we've looked at some really great trading methods today, all based on this fantastic indicator. And the takeaways, which I hope you're getting to grips with here, are the sort of processes which I'm trying to teach you. So just how simple it can be to use these indicators in terms of understanding price moves and also helping to build trade ideas and actually execute trade points in the market. Okay, so thanks a lot, everyone. And I look forward to catching up with you all next time. Thanks a lot now. Goodbye.